It begins with the kind of financial jolt that makes even veteran investors tense up, the kind of shock that slices through every valuation model you have ever trusted. On July 31st, 2025, Figma did not simply debut on the New York Stock Exchange. It ignited. A stock priced near $33 after months of careful underwriter calibration meant to engineer the usual 10 to 20% first day lift was hurled by the market to more than $140 by the close. If you are watching this in shorts format, tap the full version link below so you can hear this entire story without interruptions. And since the most current trading strategies are included later in this episode, make sure you stay until the end because it directly affects how investors are positioning right now. Under normal market behavior, IPOs rise gradually like controlled aircraft lifting off from a runway. Figma launched like a missile. When a newly public stock behaves in a way that violently breaks the normal physics of supply and demand, it means a deeper force is moving beneath the surface. It means a narrative has already taken hold, a narrative powerful enough to make investors suspend the gravitational pull of valuation logic. To understand how Figma soared that high, collapsed into the mid $30 range, and now sits at one of the most psychologically charged levels in its short public history, we have to reconstruct the chain of events that built and then shattered its valuation story. And that story begins in September 2022, when Adobe tried to acquire Figma for roughly $20 billion. In a typical acquisition of this scale, the choreography is smooth. Negotiations take place quietly, regulatory reviews proceed methodically. Unless there is an obvious antitrust conflict, approvals arrive and integration begins. But Adobe's pursuit of Figma deviated immediately from this predictable process. Regulators in the United States and Europe raised alarms almost at once. Designers protested the merger publicly. Competitors warned it would effectively eliminate the only viable challenger to Adobe's design empire. And by December 18, 2023, the deal collapsed. Then came the anomaly. Adobe still paid roughly $1 billion in breakup compensation. Usually, breakup fees are paid only when the buyer itself backs away. Here, Adobe paid, even though regulators, not the company, stopped the deal. That unusual outcome carried a powerful implication. It told investors that Adobe believed Figma was strategically priceless, that regulators considered Figma essential to competitive balance, and that Figma's independence mattered more to the ecosystem than a consolidation victory for one of the world's largest software companies. This created the first major narrative. Figma was no longer just a collaboration tool, it was infrastructure. By April 2025, Figma filed confidential IPO documents. On July 1st, the S1 became public, revealing nearly $1 billion in annual revenue, roughly 40% annual growth, extraordinary gross margins, and positive free cash flow. For a collaborative design platform scaling globally, this was an unusually strong combination. But beneath that strong financial profile, a second anomaly was brewing. Historically, companies with similar growth and revenue debut at 10 to 15 times trailing sales. Figma's valuation multiple broke past 20 and then 30 immediately after listing. Investors were no longer pricing Figma as a fast-growing software company. They were pricing it as a monopoly in the making. When valuation gets that far ahead of fundamentals, all it needs is one destabilizing catalyst. And that catalyst arrived from a surprising direction. Not from slowing revenue, not from shrinking margins, not from competitive threats. It came from dilution so extreme it shattered investor confidence. Normally, an IPO triggers modest dilution. Preferred shares convert, employee equity vests gradually. Stock-based compensation is recognized over years in smooth increments. Share counts increase 5 to 15% in a typical year. Figma did not follow that playbook. Within 12 months, Figma's share count expanded by nearly 40%. Quarter to quarter, the count jumped roughly 85%. And then came the most jarring figure, more than $1 billion of stock-based compensation recognized in a single quarter. In a normal situation, this amount would have been spread across several years. Compressing years of compensation into one period created an accounting shockwave that obliterated the stability of shareholder value. Even though the expense was technically a one-time event, Investors felt its psychological weight instantly. Analysts began circulating the phrase that defined the stock's sentiment: 13 times dilution. Whether strictly accurate or not, it captured the mood. Ownership had been weakened, and once the dilution narrative forms, it behaves like financial gravity. The stock slid from $140 to $70, then to $50, and then into the 30s. It was not sharp or sudden. It was slow and punishing. But while the valuation narrative fell apart, Figma was reinventing itself technically in ways that could rewrite the long-term story. In May 2025, the company used its Config conference to reveal a sweeping transformation. Figma sites allowed instant web publishing. Figma Make generated interfaces from natural language. Buzz automated branded content. Draw expanded AI-powered illustration. The Modify acquisition inserted advanced graphics and animation. Payload integration introduced CMS logic directly into design flow. And in October, Figma acquired Weavy, which became Figma Weave, a multimedia engine blending design, motion, and generative elements in one unified environment. Then came the turning point. At OpenAI's Dev Day in late 2025, ChatGPT invoked Figma directly in a live demonstration. Historically, design tools exist outside language models. Users switch apps, export files, or manually reassemble ideas. But in this moment, AI acted not as an assistant, but as an orchestrator, pulling Figma into its workflow as if it were a native cognitive extension. The stock surged around 15% in a single session. For the first time since the dilution shock, investors sensed that a new narrative was forming. Today, Figma trades near $34. RSI sits around 20, signaling deep oversold conditions. The price remains far below the 50-day moving average, near $50. Analyst consensus places a 12-month target near $68, roughly double the current level. And investors, balancing dilution trauma against AI optimism, find themselves standing at a narrative crossroads. From this tension, clear strategies emerge. In the short term, the $33 to $36 range forms a compressed oversold band where mean reversion is common. A reflexive move toward $38 or $40 fits historical correction patterns. In the midterm, the battleground lies between the high 40s and low 50s. Clearing that zone would demonstrate that the market views the dilution event as isolated rather than structural, and that enterprise adoption of Figma's AI suite is accelerating. And in the long term, everything depends on whether Figma's expanded ecosystem can maintain annual revenue growth near 30% and evolve into the default creation infrastructure across design, engineering, and content. If it succeeds, valuation multiples in the mid-teens are achievable again, placing natural long-term value in the $50 to $70 corridor. As this story reaches its final notes, if you are finding value in this analysis, your comments, shares, likes, and subscriptions truly help sustain this work. To those who consistently watch until the end and share these episodes outward into your networks, thank you. I will repay that energy with even stronger content. Figma's journey shows how narratives rise, fracture, and reform. The IPO myth collapsed under the force of dilution, but the company's AI reinvention is now fighting to rewrite the trajectory. Today's price is not the conclusion. It is the hinge between two competing futures. This was Value Stir.